Hey everyone, how's it going? It is 6 a.m. Half an hour before the market's going to open on Wednesday, May 15th. The big report that we've been waiting for has come out about half an hour ago, the CPI report. So we'll see how the market has reacted to that. Yesterday, we saw the potential for a bull trap forming, and so we'll see if that's still there, whether it got diffused, it got triggered, or what's happening. So first, we're going to take a look in the futures, and the futures are up. S&P 500 over half a percentage point. The NASDAQ futures half a percentage point, and the Dow futures about for almost 40 basis points. So the market is up. It's non-random, but it's not hugely up. It's not that far beyond random, which is interesting because if we had a really good CPI report, you would expect this to be much higher. In the last couple of weeks, we've seen the S&P 500, NASDAQ, and Dow, we've seen them up about a 1 percentage point, an entire percentage point. And this is only about half a percentage point. And that is off of a really big report. So that's kind of interesting to note. So definitely positive, definitely non-random, but it's just not up that big. So let's see how that report came out. CPI. Oh, we also had retail sales. We'll take a look at that too. So CPI month on month on consensus. Okay, the year on year at consensus as well. X food and energy month on month. Everything came in right at consensus. So no surprises. I guess that's probably why we're not hugely up. It does look like at least the initial reports are telling us that we are coming down X food and energy. This is what the Fed looks at. So there would definitely be some enthusiasm in the market because this makes it a little bit more likely that the Fed is going to cut rates. However, Powell, out of his mouth, insisted repeatedly, we're not inclined to raise rates. We just want to see how the current policy, we want to give it time to work. So basically, he laid out two options on the table. We're going to do nothing, which was the strong emphasis, or we might raise rates. But this does make it a little bit more likely that we're going to cut, but that wasn't one of the options that he put on the table. So most likely the market's going to, just based on what they've been doing over the past year and a half, at least, we're just going to interpret this as, yay, we're going to have a higher chance of cutting rates, rather than the reality, which is, okay, yeah, true, we have a higher probability of cutting rates, but that probability went from like 5% to 6 or 7%, not 50% to 80%. So we might get a bit of a market reaction. Well, we already know based on the futures, we got a bit of a market reaction to this, but like I said, it's not that big so far. We'll take a closer look in detail at the charts, but so far, just based off the futures market, the reaction hasn't been huge. Retail sales month on month. Wow. Okay. So this could be one of the reasons why the reaction is muted. Prior, we had grown 0.7%, and on this month, we've grown 0%. So we're completely flat. The X vehicles, we only went up 2%. So vehicles is not contributing to that. So X vehicles and gas, look at that, we're actually down. That is not good news at all for the state of the economy. But I guess that's sort of what the Fed wanted. They wanted more people out of jobs. They want more people struggling on their month to month because that means they'll buy less or spend less, or presumably they'll spend less, and then maybe from the demand side, inflation could come down. So Fed is sort of getting what they wanted on retail sales. What it shows is that consumer confidence is probably way, way, way down. We had a consumer confidence report last week, and that definitely showed that consumer confidence was down. Retail sales is showing us that people are really starting to pinch pennies. That may be what the Fed was looking for, but this type of numbers, if this continues, this implies recession. If this continues, this implies recession. So back because I started my career with the financial crisis of 2007, 2008, it's always strong in my mind. And it's the recession that I'll go back. So it's stronger in my mind than COVID, for example. And that started, I remember I had some friends who got together and they wanted to start a restaurant. And I was a potential financier of that restaurant. And I actually agreed. I liked their idea and I was going to be the main investor inside of their restaurant. But I pulled back in the summer of 2007 and they got so upset at me. But the reason why I pulled back was that was the first time, the summer of 2007 was the first time Starbucks started to advertise ever. They never had to advertise. They were just making money hand over fist without even advertising. And suddenly you started to see ads for Starbucks that summer. And what that told me was that Starbucks was hurting. Their sales were going down. They needed to advertise in order to drive people into their stores. So that meant that the consumer or retail sales was down. When you see retail sales down and they start to decline, that is the beginning of recessionary activity. So this is not great news. This is not great news at all for 6 months, 1 year down the road. So for me, in 2007, I saw it in the summer, and then by September, October, we were already in having trouble. We were at the beginning of the financial crisis. So this is not great news for us. It might be interesting to see what Starbucks is doing next. But the retail sales came in. That's terrible. We still have a couple more reports, nothing super big, except this petroleum report might have an effect on the energy market. Kashkari has been opening his mouth a lot lately, and the market and the news seem to follow him a little bit more than these other guys. Loretta Mester, Kashkari, Bowman, these are bigger names other than Powell. So Kashkari could have, and Bowman together could have a little bit of an effect on the market. So it looks like we're not really in the clear until about 9 a.m. this morning. But really, we would wait. Actually, the major reports are over already. So let's take a look at how we're reacting on the intraday. So pre-market, huge spike up after the CPI, down a little bit, but not that much. So pretty steady. So what this has shown us is that in the pre-market, we're already above the all-time high. Interesting, because what did we have yesterday developing? We started to develop a bull trap. This, you would think, could diffuse that bull trap. You'd say, okay, well, actually we went up. So we cleared the all-time high. There's no resistance overhead. We're just going to fly out and we're going to crush all the shorts that were here at the all-time high. And we're just going to go flying. We'll see. Because of this bull, that's what I would normally say actually. But because we had this bull trap setting up, usually institutions will not let their trap, unless they're scrambling to undo it, then they're probably not going to give up on this bull trap. So let's take a closer look to see whether or not we believe that bull trap just could be canceled and we're on our way up. Normally, we're not up huge. We're up a little bit, even though we crossed above these all-time highs. Let's take a look at that in context. 525.89. 525.89 is up here. Okay, so a little bit above the all-time highs, not screaming higher. So that's interesting to note. It's not this huge movement upwards as we noted in the futures. Okay, this is a lot more telling. The Nasdaq on the news touched its all-time high in the pre-market and then backed off. The Nasdaq is not at all-time highs. The SPY the S&P 500 is above all-time highs. So if I look at QQQ, we're still not there. Even in the pre-market, we're still not at the top of this green box right here. Let's look at Russell. Russell is not matching these highs up here yet. Not even close to all-time highs. And Dow Jones, also not quite at all-time highs. So what I'm seeing is the S&P 500 clearly above all-time highs and none of the other indices following. That is an incomplete picture. That is a diverging picture. So that's supporting the bull trap theory. Because even if I have a large pool of money, even if I have hundreds of millions of dollars, or collectively we have hundreds of millions of dollars or billions of dollars, we're not going to affect every single index all at the same time. We might be able to affect one, but we can't affect all. So it does look like that bull trap is still in place. Why? Another reason why is that if this was a true bull, we would expect the NASDAQ to lead, or the IWM. But in this case, the IWM is so far behind, we would expect the NASDAQ to lead, not the SPY. NASDAQ would be leading if this was a true bull. It could become a true bull later, next week or the week after. But as of right now, off of the CPI news, this is not a true bull. SPY is up above all-time highs, and that NASDAQ is below all-time highs. This is not a true bull. What that means is, in order for the SPY to be above all-time highs, but the NASDAQ not, that means this SPY movement is supported not by the tech, not by the growth stocks, not by consumer discretionary. It's supported by something like industrials or materials or consumer staples. That is not bullish. That is defensive. However, my Dow Jones is also not at the all-time high. So that means the thing that's driving the S&P 500 up over the all-time highs also is not blue chip stocks. It's also not the defensive sectors. So what is driving the S&P above all-time highs? It's got to be speculation. It's got to be call buying or some of futures buying in the SPY as an index specifically, not in the individual components of the SPY. So what I said right there was really important. People put bets specifically on the SPY, not on all the parts, and then all the parts drove the SPY up. So we're operating specifically only on the SPY, and that is purely speculative. And since we already had a bull trap developing right here, then this looks like this is just supporting the bull trap. It does not look like it is broad-based. It does not look like it is support for the entire market. It is not being supported by the QQQ. It's not being supported by the Dow Jones, even though they are up. They're not above their all-time highs. So this peak above the all-time highs is suspect. And it looks like a bull trap. So what's going to happen? We're opening up above all-time highs. Probably, since there is a bull trap here, it looks like there's a bull trap here, and normal institutional behavior anyways would be on a gap up, take profits. Take profits in that first half hour, in the first hour of the market where it's especially liquid. And so what we'll probably see almost for sure, because we see this bull trap happening, is we're going to drop at or near the open sometime within the first half hour, maybe 1 hour, but most likely first half hour. We're probably going to see these drive lower towards this 524, and depending on how hard this trap sprung, so the trap was actually developed over here, so most likely we'll go all the way down to 522 at the very least, because this trap has to have an effect. So And given that we gapped up, and given that 70% of the time we revert towards the previous close, all of this is pointing towards downward movement within that first hour, most likely half hour in this case because of the bull trap that was put into place. And because it was a bull trap and because it was laid out very well, most likely we're going not just traversing to one line. We're going to go at least two lines. That's just my opinion. That's definitely a prediction. So I wouldn't at the open just say, hey, Kane said it's going to go down and then buy a whole bunch of puts. No, that's not what you want to do, because again, this is just my read on the market and what's happening. I could absolutely be wrong, but based on what I'm seeing and based on my experience, that is the very, very, very likely scenario. So what would you do? You would say, well, is Kane right? Does it go down and hit this VWAP? Does it go down and cross the VWAP? That might be a small put position. Then we hit this 524. Do we cross it? Okay, that might be a small put position. And then do we hit this 522? Do we bounce around for a while? In this case, we might take profits on our initial puts. And if we break through that, then it might be time for another put. That's how I would play it. And then if I'm wrong, well, if I'm wrong, then we move up. Great. Doesn't matter, because we never put any money in right at the beginning. We waited to see if we would cross that VWAP. And then at some point where we pause up here, we say, okay, well, there might be some profit taking. So if we start seeing a downward momentum, then that might be a chance to buy put. And then it may be a reversion to the 524 or at least to the open. And then you have to decide whether that movement, that space is enough to be worthwhile if we only go revert back to the open. And we might not revert back to the open. We could just go here and then pause at some point and just establish an all-time high. So just because I see the high potential for something doesn't mean that it's actually going to go that way. However, that is the high potential inside the market. This is probably a bull trap waiting to be sprung sometime in the first half hour to hour of the market. So what am I going to do? How am I going to take action on this? Well, any remaining longs that I have, I'm going to act just like the institutions. Sell them while they're in maximal profit in that first half hour. And then any shorts that I have, I'll hang on to them and see. I might eat it if we go and establish all-time highs, and then I don't have my longs to balance out my shorts anymore. But it's intraday. It's not going to be a huge movement. It's not like during the day we're just going to scream higher 5, 10, 20 points in the S&P 500. Most likely the major move off of the CPI report already happened. We could move higher. Maybe we'll go to 527, 528, but we're not going to surge all the way to 530, 530. Again, I could eat my words, but it's very unlikely that we're going to move all the way up to 530 and beyond. So my shorts are kind of okay. And if that's the direction it's going to go, then I can just exit my shorts and say, hey, look, if we break 527, I'm just going to exit my shorts. And that way I took my profits on my longs and I didn't lose that much. If the market goes higher on my shorts, then I can just close them out. And so net, I should still have plenty of profit in my longs in order to make up that short. Because look at this move upward pre-market. Okay, it was from 523 to 6. Okay, so that's 3 points, but I'm only giving it 1 point of space to establish that I'm wrong on my shorts, that we're not going to come back down and revert. So that's how we want to think. My reward to risk ratios, what are my likelihoods? Even if I'm wrong, how much do I get hurt? Or do I still make money, or can I still be flat? Well, even if I'm wrong, I can still make money. I still make more money. And so if I'm right, then I took profits over here on my longs, and then we revert down, and then I can take profits on my shorts. Or if I'm wrong, or if I'm wrong, then I took profits on my longs, and then what I lose on my shorts is less than what I took profits on my longs. So either way, I come out with profits. So that's how we want to think about these markets. There's not too much more to talk about. What we really need to see is the market reaction at the open in the first half hour to hour. So we really want to see, does it develop, like I said, where we stay in the region where we opened, or maybe just a tiny bit higher, and then we come down and hit that 524 and 522? Or is it some other combination? We hit the 524 and then we bounce off, or if we actually move higher. And again, these traps were set up, and based on everything that we saw yesterday and everything that we're seeing this morning, they're waiting to be sprung, and most likely in the first half hour to hour. And so we could see big movement and then a reversion. We could still end up, even if we get the trap sprung, we could still end up higher on the day because volatility, CPI generates the volatility. And we have some economic reports happening tomorrow still. Jobless claims, Philadelphia Fed, import, export, industrial production. These four all together, well, I guess sort of housing permits, all five all together could have a cumulative effect similar to the CPI, especially since the reaction to the CPI wasn't, as we said, it wasn't huge. It was only half a percentage point. So they cumulatively could have a similar effect as the CPI. So there's still promise, there's still ability, even if this is a bull trap and we get pulled back, there still is, by the end of the week, we could still end up at new all-time highs. So just be aware, don't get sucked in to the market. If you're flat, then you have nothing to worry about. Just sit and wait until the last hour of the session before you start making any moves. If you're not flat, then do what I said, or do what I'm going to do. Well, you make a decision for yourself, but I'm going to unload my longs right here and then wait and see which direction we move, and then unload my shorts, either at an additional profit or to stop myself out. Hope that gave you guys a very clear picture of what's going on. Watch out for that trap getting sprung. And today in the aftermarket, I won't be able to attend a live, so it will be a recording. So I will see you live tomorrow morning in the pre-market.